The financial landscape in Bangladesh is on the brink of a revolutionary shift, and it's one that could redefine how we think about mobile money. But here's where it gets controversial. The Bangladesh Bank has just unveiled draft rules that could allow non-bank players to enter the mobile money arena, breaking free from the decades-old bank-dominated model. This move is bold, ambitious, and, for some, unsettling. Could this be the game-changer that democratizes digital finance, or does it open the door to unforeseen risks? Let's dive in. The central bank has published a draft of the regulations for e-money issuers in Bangladesh on its website, inviting public feedback before final approval. This isn't just a tweak to the system, it's a complete overhaul. Under the new framework, both local and foreign non-bank companies can apply for licenses to operate as payment service providers, PSPs, or mobile financial service, MFS, providers. And this is the part most people miss. Existing operators, whether bank-led or not, will have to reapply for licenses within 6 months of the rules taking effect. It's a fresh start for everyone. Currently, e-money in Bangladesh is dominated by players like bKash, Rocket, and Nagat, alongside PSPs such as Telipay and PoteoPay. These companies generate e-money through digital transactions, but they've operated in a regulatory grey zone, until now. The new rules aim to bring these activities under a formal legal and supervisory structure, ensuring stability, security, and consumer protection. But is this enough to balance innovation with risk? According to the draft, the regulations seek to promote financial inclusion, ensure the safety and reliability of e-money, and foster a competitive and innovation-driven payments environment. Sounds promising, right? A senior Bangladesh bank official, speaking anonymously, called this a milestone reform that will open up the digital finance space beyond traditional banks. The goal, they say, is to encourage competition, innovation, and interoperability. But what happens if this openness leads to vulnerabilities? Here's the catch: applicants, especially non-bank entities, dedicated EMIs or DEMIs, must meet stringent requirements. These include maintaining a minimum paid-up capital of TK 50 crore, submitting a 3-year business and risk plan, and establishing trust and settlement accounts to safeguard customer funds. They must also implement robust fraud detection systems, employ multi-factor authentication for high-value transactions, and ensure transparent governance with high-integrity directors. Violations? Expect fines of at least TK 50 lakh, license revocation, or even legal action. Industry leaders are cheering. A leading fintech executive noted, allowing non-bank EMIs could significantly accelerate innovation and partnerships in mobile and online payments. But not everyone is convinced. Critics argue that opening the market to non-bank players could dilute oversight and expose consumers to risks. Is this a leap of faith or a calculated move? The framework categorizes e-money issuers into 2 groups: authorized EMIs, banks and regulated institutions, and DEMIs, non-bank entities focused solely on e-money. Both must adhere to strict governance standards, including mandatory board audit and risk committees. The Bangladesh Bank will oversee compliance under the Payment and Settlement Systems Act, 2024, but will this be enough to prevent misuse? Once adopted, the new rules are expected to align Bangladesh's digital finance industry with international practices in countries like China, India, and Malaysia. But as we embrace this change, we must ask, are we prepared for the challenges that come with it? Will this truly democratize finance, or will it create new divides? What do you think? Is this the future of digital finance, or are we moving too fast? Share your thoughts in the comments. Let's spark a conversation that could shape the future of money in Bangladesh.